What if I told you there's a way to turn a 1% move in the market into 3% in a single day? Sounds like a cheat code, right? Leveraged ETFs promise exactly that. But here's the catch. The same multiplier that boosts your wins can triple your losses just as fast. Stick with me to the end, and you'll not only understand how these funds really work, you'll also get a simple, practical checklist to decide when to use them and when to walk away. First, plain language. An ETF is a basket of investments you can buy like a stock. A leveraged ETF takes that basket and adds financial power tools like swaps and futures, so the fund aims to deliver 2 or 3 times the daily move of its target index. If the index goes up 1% today, a 3x leveraged ETF tries to go up roughly 3% today. If the index drops 1%, the 3x fund aims to drop around 3%. It's like pressing the accelerator on a sports car. You'll get there faster, but your margin for error shrinks dramatically. Here's the part most people miss. Leveraged ETFs are designed for daily performance, and they reset every day. Imagine hiking up and down a series of hills with a heavy backpack. Even if you end at the same elevation where you started, the up and down journey leaves you more exhausted than if you walked a flat trail. That path dependency is what happens with leveraged ETFs. The day-to-day compounding and rebalancing means your longer-term return can drift far away from 3x the index. You're not multiplying the month, you're multiplying each day, one at a time, and the sequence of ups and downs matters. Let's make it concrete. Suppose you invest $10,000 in a 3x fund that tracks a financial sector index. Day 1, the index rises 1%, your fund aims for about plus 3%, so your $10,000 becomes $10,300. Day 2, the index falls 2%, your fund aims for about minus 6%, so your $10,300 becomes $9,682. Day 3, the index rises 0.5%, the fund targets about plus 1.5%, taking you to roughly $9,827. Over those 3 days, the index is barely down, but your leveraged fund is down more because each day's move hits a new larger or smaller balance. That's the compounding effect. Powerful on steady trends, punishing in choppy markets. Another thing to know, costs. Leveraged ETFs typically carry higher expense ratios than standard ETFs because those derivatives and daily rebalancing aren't free. Add in trading spreads and the fact that some of these funds can be less liquid, and the friction starts to matter, especially if you hold longer than a day or two. Think of it like renting high-performance racing tires. They grip the road when you're cornering at speed, but they wear out fast if you use them for your commute. Now, are leveraged ETFs automatically bad? Not at all. They're tools. In hands that know what they're doing, they can be useful for short-term trading, hedging a portfolio, or laser targeting a view on a sector or index. Want to bet that semiconductors will bounce on earnings this week? A sector-specific 3x bull ETF can magnify a correct call. Worried a market shock could hit banks tomorrow? A 3x bear fund can amplify a downside hedge for a single session. The point is purpose. If you go in without a plan, you're stepping into a lightning storm holding a metal umbrella. So how do you use these funds responsibly? Here's a practical step-by-step playbook. Step 1. Define your time frame in hours and days, not months and years. These funds are designed for daily targets. If your thesis is over the next 6 months, a leveraged ETF is usually the wrong instrument. If your thesis is over the next 1 to 3 trading days after this catalyst, now you're in the right neighborhood. Step 2. Position sizing. Decide your maximum loss before you enter. A simple rule of thumb for short-term trades is to risk no more than 1% to 2% of your portfolio on any single leveraged ETF trade. If your account is $20,000, your max loss on the trade might be $200 to $400. Work backward from that dollar amount to decide how many shares you can buy. Step 3. Use stop loss and take profit levels. Before you click buy, write down your exit plan. For example, I buy at $50, I'll stop out at $47, and I'll take profit at $55. That's about -6% risk and plus 10% potential reward. And you can adjust those numbers to fit your strategy. The power of leverage means your trade can hit either level quickly. Have your exits pre-programmed, not improvised. Step 5. Align your trade with volatility and catalysts. Leveraged ETFs love momentum. Earnings reports, major economic releases, central bank decisions, these events can create clear, forceful moves. Choppy, low-conviction markets, on the other hand, erode leveraged positions through day-to-day whiplash. Step 6. Understand the underlying index. Read the fund's objective and holdings. Is it tracking large tech companies, regional banks, treasuries? Does it use swaps, futures, or both? And is it a bull, long, or bear, inverse fund? Inverse leveraged ETFs move opposite the index, and they can be even trickier to hold because many markets rise more often than they fall. Always know what you're actually magnifying. Step 6. Consider liquidity. Look at average daily volume and the bid-ask spread. If you have to pay a wide spread to get in and out, your hidden cost can eat a meaningful chunk of your gain or add to your loss. Favor funds with robust trading volume and tight spreads when possible. Step 7. Cap your holding period. If your trade isn't working by the end of your planned window, say 1 to 3 days, close it. Leverage doesn't forgive indecision. The longer you drift, the more daily resets, fees, and noise can chip away at your capital. Let's talk psychology. Leverage plays with your head. A 3% move feels like a win until a -6% day shows up out of nowhere. The antidote is discipline. Pre-commit to your rules. Treat leverage like a power tool with a safety guard. You keep both hands on it and you do one precise cut, not a freestyle sculpture. Now, a few common mistakes to avoid. Don't treat leveraged ETFs as long-term core holdings. They're not designed for that, and tracking error plus compounding can lead to outcomes you didn't sign up for. Don't average down recklessly. If you're wrong, get out and reassess rather than doubling a losing position. Don't ignore the prospectus. Yes, it's dry. No, it's not optional. Understanding how your fund seeks exposure, daily target, reset mechanics, and derivatives used can save you from nasty surprises. If you're brand new, here's a safe way to practice. Paper trade first. Write down your hypothetical entries, stops, and targets for a week. Track how you would have done. If you can't make money on paper with clear rules, adding real dollars and leverage won't fix it. Next, start tiny. So tiny that a loss feels like a lesson, not a punch in the gut. Build confidence, not scars. One last metaphor to lock this in. Think of leveraged ETFs like a chainsaw. In trained hands, they cut through thick branches quickly and cleanly. In casual hands, they're dangerous. The goal isn't to scare you off, it's to respect the tool. Used for the right job, with the right plan, they can be incredibly effective. Used casually, they can turn small mistakes into big ones. Here's your quick takeaway checklist you can screenshot in your mind. Is my thesis short-term and event-driven? Do I know the exact index and whether it's bull or bear? Have I sized the position so a loss is only 1 to 2% of my account? Are my stop and targets set before entry? Is the fund liquid with a tight spread? Do I have a maximum holding period of 1 to 3 days? If you can't say yes to each, don't take the trade. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. If you found this helpful, make sure you watch to the very end of future videos in this series. We'll walk through real-world examples and break down the decision-making step by step. For now, remember, leverage magnifies discipline as much as it magnifies returns. Bring a plan or don't bring leverage.